Hey guys, it's January 14. I thought I'd put together a quick video on Friday's price action. I thought Friday's price action was really nice. Lots of opportunities there, and just kind of been a little quiet lately because I've been playing around with a different sort of setup for swing trading that I think you will appreciate. So, on the left side of this setup, I have just a chart with the price action and volume at the bottom, a volume indicator, and I have the stochastic here as well. Okay, left side here is a price action chart, and the only thing I want to see here is the moving average. I want to see price, I want to see the moving averages, and I want to put my stochastic here. This over here is my entry chart, my reference chart. This is the entry chart. Okay, that's why the two look a little different. Why do I want to set this up like this? Well, on this chart, on the reference chart, I want to see the ranges. I want to be able to focus in on range. What range are we in? Okay, I don't want to worry about pullbacks. I don't want to worry about when to get in, which is like kind of the pullback question. What I want to worry about on the range side is what is the range I'm in and what's the volume I'm in. Those are the two big things, and direction. All right. So it took me a long time to kind of figure this one out too. But on the range side, you can get as macroscopic or as microscopic as you want to. You can go to the 4-hour, you can go to the daily, you can go on to the weekly if you want. Okay, all of that is up to you. That's the beauty of having. I don't think you need a ton of screens. I think you need 2 screens. Okay, that's why you see a lot of professional traders. They only have 2 screens they're dealing with. They don't have 50 screens. At least the guys that I know. All right, so. So on the weekly, and then of course you could look out at the monthly, go way out. Why are we doing that? Remove. Let's take out some of this stuff here. You're doing that mainly to find levels. Those levels are important. So like this is the month. It's a couple months ago. It's the previous month high, previous month low. And they tend to stick around, like when we get up here, probably act as resistance. When we came down here, acted as support. And you can get as granular as you want to with this. Here's the daily level, So you can see we're kind of heading back up to the previous month high. These are daily ranges. So where we are now, like on the daily range, you would be doing like this. You'd be coming here. Previous day low. This is Friday's low. This is Thursday's high up here. And we're right up on Thursday, previous day high. Okay. Matter of fact, we hit it, and now we're bouncing back off of it a little bit. Is that clear? All right. All right. So. Now that I have that daily level in, right? Let's keep drilling down. Let's keep going down. We can go to our 4-hour. What am I looking at on the 4-hour? I'm looking at what range I'm in on the 4-hour chart. So here, you can see at the 5 a.m., we're still kind of in that 5 a.m. range from Thursday, the 5 to 9. All right. And just from my experience, I've found that a lot of volume. Where that volume is, these big volume spikes, that's where, those ranges hold up, meaning they typically continue as support or resistance, and then they go on to make new highs or new lows. Okay. So you can see we had a little sell-off, high volume here, but then the bulls kick back in, in the 9 to 1 New York session on Friday. All right, so that's the 9 to 1, and then in the afternoon session we put in a new high. All right, now on this side, on this side of the picture, I'm looking at two things. I'm looking at, this is a 1 minute chart, and I'm looking at a ribbon study, the moving average ribbon, if you want to add that to your chart. It has all the major moving averages. All right, what are we trying to do here? We're trying to get a sense of real-time range, like real-time range, okay? Not, we're always trying to get a sense of what the range is, right? So right now, okay, like if you were going to say, well, what is the current range? All right, you have a 200 here, 200 moving average here. You have the previous high here, okay? And I'm just gonna make a mark here, okay? Here's where the 200 is. And here, up here, is where the most recent high, right here, right? Bouncing off that daily level, pulled back into the range. And now you're kind of pulling back a little bit more. But this range here, right? This range that we're seeing over here, when you're swing trading, has to correlate with the range you're seeing here. Okay, so in other words, if you were to go long right now, you wouldn't go all the way down here. You wouldn't go all the way down there. Let me grab that. You wouldn't go all the way here. You wouldn't need to, because what is this guy telling you? This guy is telling you this is the current range from here, 4024, to 4012, right? Okay? For this range is the current most up-to-date data that we have is on that 1 minute chart. Not the 4 hour. The 4 hour gives us a sense of range, but really it's this guy that's giving us the most kind of accurate range. So what you do as a swing trader is you might be looking at your 15 minute and seeing, okay, if I want to get long here, market has put in a high, pulled back right here into the range. Okay, so if you're going long here, your stop is like below that 200. What range does that put you in over here? Okay, that puts you more like most accurately right here at the 515. Now, how is the volume looking there? Volume's looking pretty good. I mean, you're looking at late afternoon volume, so it was wearing off at that time. But let's look a little bit earlier in the day, like right here, 1 o'clock. Okay, so at 1 o'clock, right in here, and again, you don't have to be. You can step out a little bit. You can go to your half-hour chart. Let me just take off some of these. Remove drawings. We're going to remove those drawings. Okay. All right, so right here, you see the pullback. Here was the range. Here was the most recent high. And here was, the pullback to the lows. Okay, right in there. Okay, so that puts us on our, on our range chart, our reference chart. That puts us here. So our stop loss will be going below this candle. You don't want to take on more risk than you have to. That's what the main point is here. Okay, so here was the 1230 candle, 1.5 hour chart. This is the 1230 candle. You put in a new high, above average volume, right? Market pulled back into the moving averages, into the range. I'll show you another tool you can use to measure that pullback. You can come up here and you can grab your Fibonacci retracement tool, and you want to start from the bottom, go up to the top. Okay, that's the entire range that was done. That was the entire move that was done at 1230. All right, so here was the high. What did it do? It pulled back 60 past the 618 level, 68% into the moving averages. Right? Pulled back pretty far there. Didn't break the range though. Didn't break it. So ideally you're getting in here on these candles here, the red candles. Stochastic, oversold. See that? So you're getting in here. Stop loss is below the the half an hour candle that was most recently formed. And when the market moves back up, right, you're moving your stop to the overbought candle. Now you're moving your stop here. So you're getting in when the market, when on these red candles, and you're getting out on the green. In on red, out on green. Okay, let's look at the next one. Here's the next one here at 130. Not much of a pullback, but let's look at how let's look at our ranges. How are they looking at that point? Drawings. Remove. Okay, so here, right? You're looking at 1400 somewhere in there. 1400. There we go. So at 1400, this is the range here. All right, so we're gonna just mark that. That's the range we're looking at. Whoops. Still on the half an hour chart. 1400. And we're just gonna do a retracement. So here's 1400. We're gonna measure that like this. Okay. Okay, let me just put the time thing on there. I'm going for the time level like this. Right after 1400. So we know that this here, okay, was the end of 1400. Now, after that was done, what did it do? It pulled back into those moving averages. You had one, two opportunities to really get in pretty good there. So right here, right there, you were almost a little hitting on the 618 level. of this range. So you put in the high, pull back 61%. That's your entry right there. Stochastic helps with that, right? Stochastic helps with that. All right, so your entry, let's say, was here at 4066. And you had a couple exits. You had one here at 447. You had an exit there. That's a 4-point profit on a 3-point risk. You had another exit right here that was basically 4 points. Hit the high on a 3-point risk. Okay, here you were risking to get to the low. Remember, your stop loss is right under here. So if you were on this, if you were looking at both charts, you're looking here. This is the range you're playing here. You don't want to take on any more risk than you have to. Your 200 is way down here. Yeah, true. But this guy's telling you, over the last half an hour, price is, the high and the low is here. So that's what you're really using both screens for. All right, so here you're coming down here. You don't have to come all the way down here to your 200. No. I mean, that would put you're taking on more risk than you have to. You're looking at your half an hour. You might be drilling down to your 15, okay? But the market told you right here that the high was here and the low was here. Now you correlate that to your 1 minute chart. All right. So let's say you enter long on this candle. Your risk here is about 4 ticks. Stochastic is oversold. And you're waiting, to get you're waiting to get back over bought again. So from here's your entry long, and somewhere in here you're getting out, or you're covering, right? You're taking your stop loss from here and moving it under this guy that is clearly overbought. Okay, and your stochastic is telling you momentum is slowing right here. Fast is crossing over slow. And that's, a very consistent thing that happens. You didn't pull back far, but you did pull back. Now here you had a little signal. Not a great pullback, but nonetheless, you're not taking on a lot of risk at 15.14. Let's see how this candle looks here. If we just highlight that like so. Okay. So here, you can see that highlighted box there. If you got in long here, your risk is 5 ticks to get below that low on the 1430 candle, which was already formed, because here we are at 5:15. And then you are going when you get long, see, you want to get in on the close lower and get out when the market's making that push up. So that was a 1-to-1. Risk 5 to make 5. All right, let's do one more. All right, so, and if you were lucky, you would have captured all of that by there's a way to do it. You could be looking down here on the 1, okay, And you can see here that that candle, that's why you really want to look at the volume on the exit. You know, look at that volume at 1535 candle. 1535, huge volume, right? And that range remained, you know, intact. This one was pretty good. The 1526 was pretty good. So you would have been in here if at this one, stop below here, and you potentially could have got this. Potentially, you might have got the whole move. If you didn't, you wait for the pullback, and you would be long here. Okay, let's see on our half hour where we are. Going to the half hour over here. Okay, and maybe wasn't that one, it was this one, this candle. Okay, and so let's highlight that like so. Actually, you really just want to highlight the low and the high, the low and the close, because you know that's where the buyers reside, right? All right, so let's say you were long. This is the end of that candle here, timestamp. Put in a high, pull back, and you're in long. See that tail right there, what might have taken you out, this one. Okay, and that's kind of why you have to give it a little more room. That's another 5 points there to get to the 200. You'd be here, which is stop, the 1500 candle. Okay, so your stop is here, and you would be looking at your stochastic, looking for a slowing of momentum right after here, right? When you see that fast clearly cross below the slow, that would have been this candle. That's when you move your stop loss to cover. You take, you're moving from here to here. So from here, see, your risk is 6 points. On a mini contract, 6 points is equivalent to $30 on the ES contract. The big contract, that'd be equivalent to 300. So it's 100 times delta. Okay. So here is your stop. So you risked a little more than what you got there, but market continued to move up a little bit more. You might have captured this little bit there, and then you would have been taken out. So there were a lot of nice opportunities on that. Was only a few of them. You still had, let's just close this side off. And you can see, like, once the market made that reversal at right here, 9:30, 9:45. See it then? That's boom. It came through closed above the 200, pulled back. And that's when you would have started taking those trades, right? And here, there. There was a few of them, really nice ones, like here. lots of little ones in here. We went over a few of those. These like 1-to-1s. And now going into the open on Sunday. Now we're still in this range here, the 1530 range. High volume, right? And that's our range. So on the 1 minute, you would let the market Sunday or actually no, it might not be open Sunday because this is Martin Luther King. But in any case, when it does open up, you see, this is the range. This is the range you're playing. This one, the 1530 range. If you zoom out a little bit, you can see it a little more clear. Like you're still in this range here, right? So now stop losses. Let's say the market opens right up. Okay, so your stop loss is right here. If you want to take a little more risk, you go here, 6 points. And when the stochastic gets back overbought again, above that 80 level, what's going on? Yeah. Okay. There we go. So when the stochastic gets back overbought again, you're looking at covering that. You take your stop loss from here, put it under that candle that is closing up. You move your stop loss from here to here. And then let the market take you out. Boom. It's the reverse, start the process all over again. Until otherwise. Right now, the condition is clearly bullish. Clearly bullish. So you're going to always correlate, what range to the moving average, what the moving averages are telling you, because this is more of a real-time indicator. But you're using both. Like for years, I was doing taking on way too much risk by saying, oh, okay, well, here's the 4-hour range. Let me put my stop loss way down here. And you can clearly see that there's tons of opportunity. Like in this whole move up, you look at your 1 minute. Okay. First of all, it's nice to look at, isn't it? You got a nice visual there. Let's close this out. Go over there. Okay. All right. We're wrapping up soon. All right. So in this up move, market was right here. Boom. That's when you started switching from bearish condition to bullish condition. Okay. So ever since that, when that happens, you're looking for long entry. All right. We had lots of them. Some were better than others. Okay. But every time the stochastic hits an extreme, you should be thinking entry, exit, entry or exit, entry or exit. One of those. If you're on the upside of the 200, you're looking for long. If you're on the opposite side of the 200, all in here, you're looking for short entries, right? All right, so that is your crossover point. Okay, you had an entry here. You had an entry here, there. See, I'm looking here, right? I'm looking for the pullback. Here, here, right? That whole time, notice something. What do you notice that whole time? Okay, a lot of. You could have made a ton of moves that day, ton of opportunities that day. All right. You don't have to, number one, you don't have to get all of these. You could just get one and be done for the day. But anyway, look at that. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, and now 13 potential entries. From 10 to the end of the day. Tons of opportunities. And even, you don't need to capture all of them. You capture one. Just capture one. Oh, the other thing you notice here too is that the 200 is a great indicator. They call it a lagging indicator. It's a good thing it's lagging because it tells you really what is the range, right? So like in here, the range is from here to here. Okay, then at this point, the range is from here to here. The range is contracting. At this point, the range was from here to here. Smaller range. Market is contracting. Volatility is getting lower. In this period, range was from here to here. Right? And here, volatility kind of picked up a little bit here. Range is from here to here. And here, range is from here. At the end of the day, volatility really contracts. So you can see that you didn't have the range is basically kind of getting smaller. All right, let's look at our range chart over here. Pull in the 15 or the 30, and you can see all the possible entries you had over the course of the day. And those ranges correlate to, some of those half an hour ranges, right? See the low, high. That one was probably the lowest risk period right here. And high reward. But right now we're right here. High, and also I look at the volume. Volume is important. Okay, I want to be in on a high volume range. So that first one, that big blast off at 10, that was a big move, and they stayed in that range for a couple of hours. Here's that range. Okay, so you didn't have to get in here right at the first pullback, maybe the second one. Let it settle in a little bit right here or right in here. Okay, lower risk here. See, that risk is 15 points. This risk to the low is 12 points. And if so if you're risking 12, you get back up here, you made 12. When you get back up here, that's 9. It's like a 1-to-1. If you hung in later, 16. And then, if you get up here, that's 25. So that would have been your 2-to-1 trade right there. But the longer you stay in, the more kind of risk you take. All right, I hope that's helpful. Again, left side, range. Right side, entry. Have your moving averages set up here. Keep it simple and put whatever oscillator down here. Stochastic, CCI. There's one by Wilder. They all are pretty much, same thing. I like stochastic because it's a little more visual. I'm not necessarily paying attention to a number or waiting around for a number to happen. When it's here, it's oversold. When it's here, it's overbought. When it's here, it's oversold. Here, it's overbought. So it just simplifies it a little bit. And it's been working out great. All right, we will keep them coming, guys. And in 2023, I'd like to hear a little more from you guys and what are you doing. All right, take care.